Welcome to the 990s podcast hosted by yours truly, Kevin Thompson, founder and CEO of 99 Capital Group. Thank you guys for joining us. As I always say, subscribe to the channel. As I always say, go and get my book, MLB to CFP, live on Apple and Amazon. If you have any questions, comments, or concerns, you can email us at info@99capitalgroup.com. Send us your questions. Go to the website at www.99capitalgroup.com. Schedule your appointment. As you know, we're here to do what? Educate, empower, and engage. And today we're here to go Reg BI, part 3. I promised you 3 parts, and this is part 3. I'm bringing in another professional in the industry. He is, I guess, in my opinion, he's respected, very well respected, and I wanted to bring him on because I think he has some really great insight. You don't want to miss this episode. We're talking Reg BI. We're talking the whens, the whys, the hows. Part 3. Let's get it. Ladies and gentlemen, I have Tracy Lownsberry. And the reason why I have Tracy on the call, he owns his own company, Up North Retirement in Petoskey, Michigan. A little chilly up there, right? A little chilly up there. It's better than being 105 where I'm at right now in Fort Worth, Texas. And of course, Annuity Giants. He's the founder of one of the largest annuity-specific social media groups, and also is a graduate of Fair State. He has a criminal justice degree. And by the way, Tracy, not guilty. I didn't do it. Just FYI on that. But no, I just wanted to get his insight because him and I have had some spirited conversations on LinkedIn, and we've had some things we may or may not agree on, but we've all come to a common ground. And I love having these conversations because I think it's valuable for everyone to hear this, not only just on the LinkedIn community, but just in general from clients and the service community as well. So Tracy, thank you for joining the 980s podcast today, my man.
Thanks for having me, brother. Appreciate it.
So you and I both know our industry is just battling right now, right? We have Reg BI. We have Reg BI. We have all these different things coming out. So let's just start with it. This is part 3 of my Reg BI session. And what is your interpretation around regulation best interest? Give me your best synopsis on just your interpretation of what Reg BI is supposed to represent. And if that's really broad, we can bring it back a little bit.
Well, Reg BI is broad compared to the new DOL rule. So I would say this. I would say that in general, right, it's to protect consumers from bad sales practices.
Yeah.
In general.
Yeah. So if that is the case, why are certain segments against Reg BI? Like, why is the insurance industry combating or trying to balk against Reg BI? Like, what would be your interpretation of that?
So I will say this. So the best interest standard versus the DOL rule, okay, and the fiduciary rule, which we're going to talk about.
Yeah.
I'm not against regulation. I'm not against more regulation. I think the reason why, I think it's twofold. So the reason why people don't like regulation is one of two things, okay? Either one, it's going to hurt their business model and they're looking at dollars and cents, right? And that's not, I don't care about that, right? I could care less about that. And obviously you're going to have both sides on that one. And two, I think that there are people that when you start putting in more and more regulation on something, it's when does it stop, right? And so it's that snowball effect of like, when are we going to stop allowing, we could call it the government, more regulation when, let's be honest, they don't do things very good anyway.
Yeah, they're not very good at what they do. Absolutely.
Yeah. And I was a government employee for 8 years, so I know how bad they are, in the military for 8 years. So I get it.
Everybody says the DMV, just look at the DMV.
Yeah. But it's not to say, but that's the thing is who's going to regulate it, right? So if they're not going to do it, who's going to do it? And how do we approach? I think we just need to approach it differently, in my opinion. But I think that's why. I think it's two sides of the coin there. You're going to have greed on one side, and then you're just going to have people that don't like government because things get sticky and stupid, and to be honest, I'm not opposed to that either. I think it does, especially for those of us that are doing it the right way. It makes our job a lot harder, a lot of times.
So my take, and that's great you said that, because my take's the same. I want I mean, I'm a capitalist at heart, right? I want
Yeah.
everybody to make money, however you do it, but it's got to be a proper way of getting it done. And the reason I feel the way I do, and it's not because I'm heavy fiduciary, everybody's got to be a fiduciary. No, that's not the case. If you don't want to be a fiduciary, don't be a fiduciary. No one's forcing you to be a fiduciary. But I grew up in the insurance arm of the field where, I started at a broker dealer and then I went to an insurance broker dealer. It starts with a G, ends with an N, and it's a part of the Marvel universe. So I don't want to talk about that. I started with them, and everything was, you start with insurance. You start with, how it is, right? You start in the business, you start with insurance, and that's the whole kit and caboodle. And I've learned a lot in this time to where I understand that I don't fault the agents of these companies, because this is the direction they are sold in regards to their practice. So it's not their fault. It's the company's fault. It's the general agent's fault. It's the people above them that are teaching them these tactics. Now, to go back to what I was saying, I don't believe everybody needs a fiduciary standard. All I want is this, and I don't want to start with the end in mind, but all I want is this. We have to stop muddying up what an actual financial advisor, what it means to be a financial advisor. Just define it. A financial advisor is this. And if it's the fiduciary standard, then that's what you are as a financial advisor, and you call it that. And if you're not a fiduciary and then you can't call yourself a financial advisor. Call yourself something else. But we got to quit muddying up the system. So what say you about that?
Yeah, I think the term financial advisor is a funny one. So, when I go back and I look at 3 or 4 years ago is when I really started to dive into the finance world really hard. I worked for an RIA before and worked under investment advisors, and I knew enough, but I really started diving hard into the securities inside and just planning. And I asked a lot of people that I trusted, can I call myself a financial advisor? So full disclosure, I'm insurance license only, right?
Yeah.
So I have no other license other than my insurance license. So can I call myself one? Because at the time, I was doing the annuity side, but obviously to do that appropriately, you have to kind of understand the big picture. So there was some planning involved, and it was in my early stages of my career, so I definitely made some mistakes.
Yeah.
So when we looked at it on paper, the answer is actually yes. I can legally.
Yeah.
I can legally. And now I look at that and I'm like, what in the world? How is that legal? Now, granted, you're opening up yourself to, in my opinion, some lawsuits if you make mistakes, but still, like, how is it that term is not regulated? How is it that it's not regulated? Because that is the one term that should be regulated over, in my opinion, over fiduciary.
Yeah.
So I personally, yes, I'd love to see that be a rule that comes down and says you absolutely cannot call yourself a financial advisor unless you have a securities-based license, right? Yeah. Or unless you do A, B, C, X, Y, Z. Like another, okay, so what if somebody has like a CFF? I can go get my CFF right now and not have a securities license attached to it at all, right? Yeah. So what's that make me? Am I a financial advisor? Am I just a fiduciary? What am I, right? Yeah. You have an RICP. If I go get an RICP, it is just an RICP. What can I call myself, right? Yeah. So now you have to define like what designations are associated with ABCXYZ. There's just a lot. There's a lot to that. And I think the way that we have it regulated right now, from a terminology standpoint, is really stupid. Yeah. I think you can't own a word. And by the way, I think that's what you're going to hear a lot of the insurance regulators say. Like, how can you own the term fiduciary, right? Yeah. What's fiduciary mean, right? It's okay, doing what's in somebody's best interest, well above yourself, right? Yeah. Okay, so isn't that just a moral obligation, right? So how do you regulate morality? Well, the answer is you can't. Yeah. Right. Yeah. So like, where's the line? How do we draw the line?
The lines are not drawn, and you and I both know that, because we can all say the fiduciary standard is the gold standard. Well, yeah. Bernie Madoff was a fiduciary. Right. Yeah. So let's just call it what it is. You know what I mean? Yeah. Like, there's some bad people out there that are fiduciaries that are going to do bad. So you can't regulate morality. Right. You're absolutely right on that. But I guess my concern is you have, like, from my last conversation, you have people that are saying that if you disincentivize people from selling certain products, then those people won't sell those products, even if they're in the, for example, like, well, okay, one of the main questions was this. an individual I spoke to a week or so ago said that, hey, you know what? Is it fair that, let's just say, Kevin, you charge 1%, and just say it's $1 million. So that's $10,000 a year. But then if I do that same $1 million into an annuity, that's a 6% front load that I get. That's $60,000. So why do I have to disclose that? Why is it? Because it has nothing to do with the contract. So what say you on that? Like, and this is what it's about, basically disclosure, Reg BI and disclosure.
Yep.
Is that a huge issue, or should people take issue with that? Because I understand that at the end of the day, from an annuities perspective, it has no material impact on the actual contract, right? It doesn't come out of the contract. It doesn't come out of the client's money. It's a surrender chart, a surrender fee schedule, right?
Yeah. Yeah. It comes out of somewhere, right? Can we agree it comes out of somewhere?
Yeah, it's not free.
Yeah, it's not free.
It's not free.
Yeah, and you just made the argument for insurance people. You just made that argument.
No, but what I'm saying, because I like to be in the middle here, right? Like, I like to be in the middle. Like, I'm not arguing for or against. I'm just trying to figure out.
I'm switching spots with you right now because I'm going to argue against that one. I'm going to say that that comes out. That comes out of somewhere, right?
Okay.
Like, we see these big commissions coming out of insurance products. I know how they make money. I know how their balance sheets are. I know what their general accounts look like. I know what their bond portfolios are yielding for them. I know what they're making. So if one's paying 10% and one's paying 6%, come on, where's it coming out of, right? Anyways, so
I'm just here to learn myself. I'm your student, man.
Yeah.
So I'm just trying. I'm going to get that information. But yeah, like I said, the client doesn't necessarily see that. We know where it comes from, right? It comes from the caps and the spreads and all the other things that people aren't necessarily getting. Yeah, we get all of that. But at the end of the day, the clients don't see, oh, well, you make $60,000, but I still see that $1 million in my account. So it's not, we're all cool here. But
100%,
the individual I was speaking with, and again, great guy, we were just having that conversation, and I was understanding where he was coming from. But what I don't understand is that like I said to him, I said, it's okay for the race to the bottom on the fee side of the business, but it's not okay on the insurance side of the business. Why are we segmenting that? Like, if that's the issue, then there should be, the client should know, oh, well, that's $60,000. Why are you making so much money? What have you done? Well, I've provided you this product. Well, I mean, there's investment advisory guys that can do the exact same thing at 1% or what have you. So that's what their concern is it's going to become a race to the bottom and lower commissions and basically just lower money in their pockets, right?
Yeah. So I think let me set some groundwork here.
Yeah.
So the groundwork is to understand that the rule really targeted index products, right? But we have to understand there are a lot of other types of annuities too, right? So we have to take fixed products into consideration where, there could be commission on those that are 0.25% for a high age bracket with a small amount, all the way up to, let's just call it on the high end 3%, right? And obviously index annuities are not all in the same category either. There's 5-year, 7-year, 10-year, 15-year, 18-year, I think nowadays, good Lord. So, and those commissions are going to range, and we're talking street here. And I think that's important to understand too, is that these commissions, so there's a street level commission, but then there's actual NMO, commissions that come out of these products. And so we can talk about street, but really what's coming out of the product itself, going into pockets of, whatever your hierarchy is, that's an important discussion to have, because it's not just 6% coming out on a, 10-year FIA. There's probably at the very top 9, 9.5, 10. Hey, if you do 100 million with this carrier, we'll give you a bonus structure over and above that of 25 bips, 50 bips, 75 bips.
I'm glad you mentioned that. And that comes with the disclosure, right?
It should.
Yeah.
It should.
That's what it's all about. Yeah.
Yeah. So the problem now is that, so if I go and write that product, the issue with what's going on right now is that I have to tell them that, but the IMO, upline, whomever, right? They don't have to disclose what they're making over and above that. The IMO that I'm under, or NMO, or whatever it is, they don't have to say what kind of fee or bonus or whatever. But I have to disclose my commission on it as an agent writing the product. I think that if you really want to blow the doors open on this, why not disclose it all the way to the top? But also, you're going to go down a giant rabbit hole with that, because now go sell a mutual fund to somebody, right? And now to go tell me how many people are getting paid, right? Go to the hedge fund managers, how much spread do you make on that mutual fund, right?
Yeah.
How deep do you want to go down the rabbit hole? right?
Yeah.
So when you start to argue like the commission versus fees, you can go down a rabbit hole that no consumer will be happy with, because I know what some of these hedge funds make on some of these
Hey
of these
man, don't
spreads.
you take my 2 and 20, man. Don't you take my 2 and 20, man.
So no, I am for going back to your question. So I don't hold the exact same stance as that gentleman, which whom I love and care for, and he's a good guy. So I don't hold the same stance. Personally, I am a huge advocate of reducing commissions because I know what that means. So reducing commissions can do one of two things. So if you just reduce commissions on a product, well, let's just say reduce commissions in general, all it means is that more insurance companies spread, right?
Okay.
But if we can reduce commissions and then bring in some regulation that says, hey, you can't just keep that as profit, right? Like, can we have some regulations in here that says like, yeah, we have to increase your minimum on these products, or lock in some better rates or whatever it is. Like, how can we translate that to a consumer? And now you're down a very slippery slope, right? So when you start to advocate for lower commissions, how are you going to tell in a society where capitalism reigns? How are you going to tell a business that their model has to change and they have to give more to the consumer versus taking more profit? Good luck with that. But
Yeah.
with the idea that when you have a commission's disclosure on it, like, hey, this is how I get paid, versus how another fee-based advisor gets paid. Well, in the annuity world, there's been a study on that recently,
Yeah.
and so actually commissions drive better products. So it's a less of a cost to the insurance company to front load that commission. And by the way, you can take trails. I mean, I don't
Yeah.
know very
Yeah.
many
There's
people that take
25
the
bips
trails.
on a six. Yeah.
Yeah,
Yeah. Yeah.
yeah, you can take trails, but when you start adding in just a fee-based product or designing it that way, and this is the problem with the regulation right now, is that the model that compensation it's going to change, right? And it's going to go to that fee-based model, and then that's going to reduce product offerings. And it will, because we already know what it costs the insurance company, because it's already been put out there. Products that have fees, or fee-based products, RA-based products, whatever, versus commission-based products, have a pretty distinct difference in offerings and net return of the client.
So, okay. So I want to go down that rabbit hole a little bit, because
Sure.
I've done all of the kind of the numbers when I was in the broker dealer world. I'm like, hey, do I want to charge this an ABC version, on the commission
Sure.
side and all of that? And I was like, well, this makes more sense to take it up front, because I won't break even until this, whatever. I'm on the fee side, and now I see that, hey, I can charge my percentages, but I can actually control what I charge from that perspective, because it goes into the portfolio, and then I can say, okay, well, this is the overall average 1%, what yada yada yada. They can get breakpoints on it, right?
Yep.
On the
Yep.
size, it adds to it. So are you saying that it's more costly for the carrier to have investment only products when the outlay up front is lower, and my surrender schedule is basically gone away, because this basically becomes a year-to-year product, right? So how does that work?
No, it's not necessarily. So it's better for the consumer, not
Yeah,
necessarily
yeah, that's what I
the
meant. That's what I
carrier.
meant. The
Yeah.
consumer, yeah.
Yes. So it's better for the consumer. So if you go look at the product suite that we have in the fee-based world, whether that's the bank fee-based bank channels, RA channels, broker-dealer channels, do you know
And by the way, when I
share
say we, I'm talking about the consumer. I'm not saying
yeah.
we as me as
Yeah,
like
yeah, yeah.
yeah. Go ahead.
So there's a great study that Wink Intel did, Wink Intel, Cheryl Moore over there. So Cheryl did a great study on that, and she highlighted, and there's pros and cons to both.
Yeah,
But
yeah,
the
yeah.
way that she highlighted it, I suggest anybody, whether you're a consumer or an advisor, go take a peek at it. Yes, the fee-based platform won in some respective categories, but overall the commission one kind of came out ahead for net benefits to the client.
Gotcha. Hey, I need to read that. I need to read that. So
It's a good one.
yeah. So we talked about the impact to commissions. We know that there's going to be a race to like just getting a more efficient product out there. Like I said before, individuals I've spoken to in the past say that it's going to reduce compensation, which is going to reduce competition, and there's going to be less and less products. I
Yeah.
wholeheartedly believe, and this is just my 2 cents, like you said, there should be minimums. You see people putting $2,000 into this product and that. I'm like, what are you doing? Like, what are we doing here, man?
Yeah.
You know what I mean? That should be like illegal, in my opinion. Like
Yeah.
it's the same thing with people trying to fund VULs and all the other IULs with like $100 a month. They're like, we're like, gosh, you're wasting your time. You know what I mean?
Yeah.
But again, it's not the advisor or the individual who sold the product. It's the individual that taught that individual how to sell that product. To just FYI on that. Let's start with the fiduciary standard. Okay. This is where everyone hears this word. I think the CFP has done a phenomenal job of using this, touting this word as some kind of differentiator in the market. Like I said before, Bernie Madoff was a fiduciary. I'm sure Alan Stanford was probably a fiduciary. These Ponzi scheme guys were all fiduciaries to a degree. So there's a belief that Reg BI could impact commissions, like I mentioned before. But in your opinion, adopting the fiduciary standard, is that the best path forward for the financial industry? Or is it one of the things where they can say, hey, if you're an insurance agent, you don't have to be a fiduciary. You can be a sales consultant, right? You can be a you just be a sales consultant. What are your thoughts on just from the fiduciary standard and from an advisor standard, and basically the best path forward for the insurance industry?
Yeah, I'll answer that in a second. First thing I want to do is I didn't answer your question from before as far as and I do want to make a statement on this. As far as, you know, what it will do to the sales force, right? It will reduce the sales force and people, whatever, it will incentivize or decentivize people. My answer to that one, or my statement to that is who cares, right? So
it's economics. It happens everywhere. Yeah.
And I agree with that 100%. So why that would be an argument? Listen, man, I replace more annuities than I do write new ones, right?
Yeah.
So I'm always getting people out of bad ones.
Yeah.
And people say, oh, there's no bad annuity. No, there is. There's bad annuities. There's 100% bad annuities.
Yeah.
And going back to, listen, ignorance is not a defense against doing something wrong, right?
Yeah.
So we can try to push blame on these marketing companies, and it all rolls downhill. And I agree, you know, it goes from the carrier to the marketing companies to the agencies to the agents. And yeah, it rolls downhill. But at the end of the day, man, if you're out there and you are writing a product on somebody, you better be doing your due diligence. If you're going to go throw hundreds of thousands of dollars into a product that they can't get out of without significant penalties for 5, 7, 10 plus years, you better know what you're freaking doing. And if you don't, go find an upline that can do it better, or that can help you do it better. You owe that to the people you are working for, and it is not about commission. And the problem is that everybody tries to push commission in our industry, and it pisses me off, to be honest, because it's solving problems first, not selling products. And when you can do that, you'll find yourself being a millionaire at some point in your life. It's the standard.
Let me stop there, man. That was refreshing, man. That was refreshing. That came out of nowhere, and I appreciate that.
Yeah, absolutely. It's again, it's morality, right?
Yeah.
Like, do what's best. Somebody told me a long time ago, you can't do the right thing long enough without seeing positive results. So just do the right thing.
But the other side of the fence is going to be like, well, you mentioned just not knowing doesn't absolve you. But if you don't know what you don't know, and you're provided a product that you believe is in the best interest of your client, and it ends up not being, I mean, how is that? I don't know. That's just that can get.
That's called a mistake. And people make mistakes, right? And I made mistakes when I first started, but it's listen, you got to pursue knowledge with a fury that, like, it's a thirst that can't be, you know, quenched by anything, right? You just have to continuously pursue knowledge. And I see it on both ends. I see the fee-based advisors, or just, you know, securities licensed people, you know, people tell me, oh, well, this guy's been in the business for 40 years. I'm like, yeah, but he doesn't know anything about annuities. Why? Because he got to a point where he experienced comfortability, he's comfortable, and he stopped, right?
Yeah.
Same thing in the insurance world. Oh, this person is great when it comes to blah, 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 blah. Okay, and then they got comfortable. And then here's why I passed them, right? Because as soon as I get comfortable, I am getting myself in a different position. And that's how everybody should be in the industry, because in that uncomfortable setting, you're going to grow, and you're going to learn, and you're going to find what you're doing wrong, and you're going to be better. And how that translates is that you're gonna have clients that are happy with you. And by the way, I could solve the annuity issue super, super easily. And we'll get to that in a bit. But let me go back to the question you asked. Okay. What was the question again?
From the fiduciary side of things, the best path forward for the insurance industry, is it going to be being the fiduciary, or is it going to be just in your just a suitability standard, or just none of it at all?
So I would love for the insurance industry to adopt a fiduciary standard. I would
Okay.
love it. Okay. Because how would that be a bad thing? And I'm saying this from a definition standpoint, right?
Yeah.
By the word. So I think the problem with it is how and who is regulating. And we've always been regulated by the state, right?
Yeah. Yeah.
So now we have the Department of Labor, and then we have the Security and Exchange Commission and FINRA. We have all these regulating bodies that now all of a sudden, they want to kind of impose their regulation on us
Mhm.
when we start talking about qualified money, right? So the best interest standard was everything, right?
Yeah.
It was encompassing all investments. Now we have the DOL, and it's like, oh, qualified money. Okay. So I get that. I totally understand that. But the money inside of that, or the investments inside of that, still is security, right?
Mhm.
You're either in stocks, bonds, mutual funds, ETFs, REITs, whatever it is, right? So at some point, the difference now is that when you, in my opinion, I think a brokerage account should be more regulated than a qualified plan is, because I know that if things get liquidated in a qualified plan, nothing really happens, right?
Mhm.
Nothing happens from a tax standpoint. But there is a systematic process in picking and choosing what should be liquidated in a brokerage account,
Yeah.
right? Tax loss harvesting, you have capital gains tax, you have short term, long term. It's a much more systematic process when you're funding something out of a brokerage account versus a qualified plan. Qualified
Mhm.
plan's easy,
Yeah.
liquidate, right? So I like the fiduciary side of things. The problem is who regulates it, right? So here's the biggest issue I see is that you're going to regulate us like a fiduciary, but we can't call ourselves one,
Yeah.
right?
Gotcha.
So how come we get regulated like one but can't call ourselves one? So like where's the line here, right? So I have to sit here and I have to say, yeah, you have to sign this AG, or you have to sign this 8424 that
Yeah.
essentially here's my commission disclosure. Oh, and by the way, I have to act in fiduciary capacity here, and here's XYZ ABC disclosure that I have to read to you. But then, by the way, I'm not a fiduciary.
Yeah. I like the idea. I just don't. I just feel like if you don't want to be a fiduciary, you shouldn't have to be a fiduciary, and then you can act in whatever capacity you want to act, but you just can't call yourself a certain thing.
Yeah,
Um, I guess my last question is going to be in the insurance industry. We know it's not going anywhere, right? And we
yeah.
only got a couple more minutes left. We know it's not going anywhere. The framework and this battling we constantly bicker on about. I'm a fee only advisor and I'm a fee based advisor and they're doing it the wrong way. And don't you just get tired of the nonsense? Because at the end of the day, however you make money is how you make money. But why do you think we battle so hard in our industry against one another in regards to me being a fiduciary, you being a suitability individual, or maybe not being in suitability standards? Like, what's the battle here? Like why is there a superiority complex?
Because we're an industry full of egotistical maniacs. And that's just how it is. To be in the finance world and to be in sales in general, you have to be a confident person, and with confidence, a lot of times comes ego.
Yeah.
Check it at the door, by the way, because you'll have a better career. And I honestly, that's why, right? It's that superiority that I'm gonna do what's best for you because of A, B, C, X, Y, Z tests that I took.
Yeah.
Okay, so let me tell you this: majority of people that I train on annuities as a insurance license only people are CFPs and CFAs.
Yeah.
Majority of the people I train. Okay, so
Hey man, those products are intricate, man.
they
Like
are.
understanding how that. I was talking to somebody about one of the RILAs before. I was like,
Oh
"How
yeah,
do you price this?" It's a Black Scholes model on the back end side of it. I was like, "This doesn't make sense to me." But anyways, continue.
yeah. So this is what I would say: if you're going to be people ask me all the time, "Are you a fiduciary?" I'm like, "No," and I really, for me, I can't be, okay, because the way that I look at a fiduciary on paper is that you have to take everything that takes your biases away. That's a full fiduciary, okay, full
What's that
fiduciary.
mean?
What's that mean? Well, it's one. It means one thing: either I'm going to charge you hourly for my time, or I'm going to charge you upfront, no matter what you're going to do for me.
But you still have a
That's a
conflict
full
of
fiduciary.
interest. You
But
still
do
have a
you?
full.
Do you?
Yeah.
Well,
Yeah.
you don't have a conflict of interest from the standpoint of like recommendations, though. Like I
No,
don't
but
care.
you have a conflict of, but you have a conflict of interest in the standpoint of, okay, I'm gonna charge them by the hour. How much time do I want to take now? You know what I mean? Just saying, just
That's a
FYI.
good. Okay, that's a good point. I
Yeah,
like that. Time I'm
yeah,
taking. Okay, how about a flat one? I'm just going to charge you a flat one-time cost,
then they're going to say the conflict of interest is going to be, hey, I'm going to basically make this a cookie cutter because I'm going to get as many of these through as possible. It's a flat one-time fee. So like I said, there is no way to legislate this stuff.
Yeah.
And it's just so disheartening that we're battling back and forth with this stuff.
I agree. And I agree.
I don't know. It's human nature, man. It's human nature. Like I said, Tracy, thank you for being on. One last question, my friend. Where do we go from here? Where do we go from here in regards to our industry? I know we don't have a crystal ball, but if you said, Kevin, this is where I wanted to see the industry go, where would you say you want it to go?
Couple things. One, I'd like to see a standard commission model. Mm-hmm. I'd like to see a standard commission model no matter the product. I'd like to see a lot of insurance companies get away from private equity or overseas reinsurance. Okay, I'd love to see that. I'd like to see that regulated a lot better. I would like to see guaranteed minimums in products be a hell of a lot higher than they are. I'd like to see in index products. I'd like to see locked rates. I think a lot of these things would solve so many issues. And then ultimately, I would like to see a designation. And I think there are some right now, but let me make it. Okay. I'd like to see a designation specific to annuities, and maybe even just because they're so hot, maybe even specific ones for index products where that designation is something that is not a credit. Okay. It's not a continuing ed. It is an actual designation like the RICP, maybe not as in depth as some, but it's laying out all of these things that insurance agents miss and financial advisors miss. I'd love to see a regulated designation. I think that would solve so many of these issues because then, hey, you get that designation, liability is now on you, right? So you better know what the hell you're doing. I'd like to see that. A super specific designation on in my opinion, on index products, because majority of what we do. And again, I've been a big advocate of that. Hey, regulatory agencies, let me make it for you, okay? Because I know what it would look like. I'll police it. Just pay me a bunch of money to do
it. Tracy, man, thank you for joining the 90s podcast, founder of Up North Retirement, and of course, founder and trainer of Annuity Giants. He's probably one of the smartest guys I know because I'm learning a lot in regards to the annuity space. We've had banter back and forth on LinkedIn, and I was like, you know what? I like this guy. I got to have him on. And man, thank you for giving us your insight. I am not a combative person. I'm always wanting to learn, and thank you for just instructing and giving us your insight on what you think the industry's going, the direction the industry's going, and of course, Reg BI, my friend.
Thank you for having me.
We had Tracy Lownsberry. I think he's one of the most knowledgeable people in our space in the annuity side of the business. What he talks about, what he knows, the depth of knowledge that he provides on the annuity side of the business is the reason why I brought him on the show today. Thank you for joining us on the 990s podcast. We talked about Reg BI. We talked about the insurance industry. We talked about why they're balking against the system. We talked about fiduciary standard. Subscribe to the channel. Go and get my book, MLB to CFP, live on Apple and Amazon. You have any questions, comments, or concerns, you can email us at info@9icapitalgroup.com. Send us your questions. You go to the website at www.9icapitalgroup.com. Schedule an appointment. As you know, we're here to do what? Educate, empower, and engage. And I hope Tracy and I gave you a little bit of education today. The market's changing. The market's dynamic. And if you're looking for anyone to give you some information, not only about annuities, but about just life in general in regards to the financial planning side, we're here for you. Stay humble, stay safe, my friends. I'll see you again soon.